Kenya is today ranked among the countries with the best startup ecosystem in Africa. As a result, there's been a rush by investors to snap up some of these startups and scale them up. But while the funding seems to be available, there have been some horror stories as well. Deals going wrong, startups sold below their true value. And so this afternoon, we want to connect the dots, tell the stories, and learn the lessons on the do's and don'ts in attracting and securing financing from venture capitalists. Good afternoon. This is Business Now. I'm Yvonne Okwara Matole, and here are the highlights of the show. How can Kenyan startups fashion themselves to attract venture capitalists? Securing the deal without regrets. How does a startup maximize on the funding opportunity? And in our Made in Kenya segment, metal sculptures, from waste to artistic taste. And to talk about that with me, these are the guests we will be having on the show this afternoon here on Business Now. Esther Ndeti, who is heading investments at UNCUP, and she has a track record in this field for over a decade. Also on the show this afternoon, we have, who do we have? We've got James Odede, who's the founder of Lake Hub, all the way from Kisumu, who's joining us live here in Nairobi. And we'll be talking about the importance of a hub, an innovation tech hub, if you like, and he'll be telling us what they can do for you and your small business. No stranger to the show, Linda Bonya, who's the CEO and founder of Lawyers Hub. So all your questions, you can direct them to us at Citizen TV Kenya, at Yvonne Okwara. The hashtag to use is Business Now. I've seen some of your responses and your reactions to perhaps your experiences with it. And indeed, if you are running a business, how do you get yourself ready? We'll have all the answers for you with my guests in just a little while. But first, let's take a look at the latest in the world of business this afternoon. And at least 200 Kenyan businesses will attend a trade mission to the Democratic Republic of Congo later this month. This is part of Kenya's plan to deepen relations with the DRC and will be led by listed lender Equity Group, which already operates in that country. And elsewhere, Strathmore University Business School has signed a partnership with Airtel Africa to transform the agriculture sector. The deal will see the two institutions work together on areas of research, financial sourcing, training, as well as promotion of clean energy and sustainability. And finally, Airtel Africa and UNICEF have announced a 5-year partnership to accelerate the rollout of digital learning through connecting schools to the internet. This will involve 13 countries, Kenya included, at a cost of $57 million up to the year 2027. All right, it's time to now get into our discussion today. Venture capital funding, which I am sure is the dream of any business. But what are the do's and don'ts? What are the myths and what are the facts? And if you are lucky enough to secure one, how do you manage that relationship? A great conversation. We have talked about the various different types of forms of funding to businesses, and today we're zeroing in on venture capital. And here are my guests this afternoon. As we told you a little earlier, Linda Bonya, who's seated right next to me, Esther Ndeti and James Odede. Gentlemen and ladies, thank you for joining us. Esther, shall we start with you? I think just to refresh our viewers' memory, it was a while back, a couple of months ago, when we talked about the different sources of funding. Could you speak to us about venture capital funding, what it is, what it isn't?
So I'm happy that you actually have spoken about venture capital as opposed to other sources of funding. So venture capital essentially is a form of equity investing. If you think about how capital is put into business, it's either debt or equity. So venture capital falls on the equity side. Mm-hmm. So investor invests into your business, takes a stake of your business in return, works with you to grow your business to the next level, and then exits your business. They either sell the stake back, sometimes to you, but most times to other investors who are interested in this business and taking it to the next level.
Okay, and that's interesting for us to define. It's equity, and then it also has, a time span and a time frame. And I guess we've all watched all those shows, Dragon's Den and Shark Tank, and we see all of this pitching that is done. Let's talk about a little bit with you, Esther. what a typical venture capitalist will be looking for in a business. So, you know, we come and we pitch to you, and Linda, you're going to have to do another pitch. You did a really excellent one last time. Hopefully you can show us how it's done. Those elevator pitches that, you know, we hear are 20 seconds or 1 minute or whatever. So when I come to you, Esther, or anybody else, and I say, look, this is my business, this is what it is, and, you know, we're looking for this amount of money, what would you be looking for in a business to put in your investment?
So the first thing you should say is that every investor is different. So like the DNA, the mandate sits differently. But then there are the basic few things that they all look for. I think one is the solution that you're offering. You know, are you bringing in, so we like to put them in two buckets. Is it a painkiller or is it a vitamin, right? A painkiller, are you basically bringing in a new, are you addressing something that has not, an unmet need, basically? Are you bringing in something that has not been addressed before? You know, a vitamin is, there's solutions out there, but yours does exponentially better at meeting that need, basically. And the second thing we look at then, the team behind that solution. You know, do you have the track record? Do you have expertise in this? Do you have a team that not only has skills, the technical skills, but also the soft skills to be able to work together? Because the one thing that's inevitable in building a business is that you'll face issues. So how are you going to react to those issues? You know, the market isn't going the way that you thought it would, you know, or, you know, investors are not, you know, seeing eye to eye with your growth plans. So how do you react to that? So it's really important to understand the strengths of the team and what they bring into this whole, you know, business deal. And that's a really critical one. I need to really emphasize that. So they really assess who's behind this deal and how they get along and all of that. Because, you know, you can have a B-grade solution, but if you have an A team, you know that this A team will be able to figure out how to bring this B-grade solution to something that's viable in the market, right? But if you have a B-grade team and an A solution, then we have a problem.
Okay.
Yeah. Then the third thing that's critical is market. So what does the market look like? How big is the market? You know, and what is the appetite of the market for this solution that you're bringing into? So I think like, those are the three basics before you start looking at the economics of the business. You know, the financials, the go-to-market strategy, the sales. You know, there's all these other financials and economics that come into the business. But I think the critical three are solution, team, and market.
At least that gets you in the front door.
Yeah,
and then after that, now you have a conversation and see whether there's a deal. So important for you to put that in. So Linda, then how does a business get itself ready? How does a business ensure that they're getting in through the front door with at least the three things that Esther has said? Because some people think, well, you know, I mean, it's a good business. We've been doing this 5 years. So what are some of the things, you know, on paper and otherwise that a business should have together before even approaching, you know, for funding?
Yeah. I love what Esther said, and maybe I'd build up from the team and the market. I think it's important to understand what your market is. Is it a regulated market, for instance, before you look for venture, you know, funding? And so let's say you're in financial business, in banking, in insurance, knowing those would sort of help you to know, you know, what next. Unlike maybe a food business, you know, for instance, at anyone, there are very low barriers to entry. So it's important to figure that out fast. And then two, I think in terms of the team also, I think usually at the beginning point, sometimes you want to retain talent. And so you want this really good team. And so in the beginning, you simply just hand out shares and say, I want to keep you this long, and so I'm going to give you 50% of the company. And so it's important for, you know, a business at that point not to hand out a lot of equity or ownership at the beginning of the business. The other thing that maybe we talked about before on this show is just foundational documents. So if we have a shareholders agreement that says that you can't sell this to an outsider unless I have the option to buy it first as your partner.
Okay.
So then before you go to Esther,
you have to go back.
Yes, you have to go back and look at the shareholders agreement. What does it say about me selling out shares before I approach somebody else? And I think learning from our business incorporation system in Kenya, it's very easy to just go on eCitizen and register and say, I'm taking all the templates, you just take yes, 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 and then you have a company.
Yes.
But those templates mean something. They are stipulate, let's say, voting rights. How do you vote? And so we've seen startups before where you get in capital, and then what happens in the end? The moment you sell the shares, it maybe sometimes equals voting rights. And so you can be voted ideally out of your own company without knowing the ramifications, you know. So it's important to really look at those documents in terms of, does it mean that they take over management? Does it mean that they have equal voting rights? And I think the important thing also is to really talk to people in the space to find out what's the value of a share. For instance, if you're raising capital at the beginning, you know, you're simply just trying to figure out, and I want to encourage everyone to try and bootstrap in the beginning so that somebody doesn't give you a lot of money and then they own the whole company, but you haven't figured out even that product market fit, you know, in that case. Yeah.
Okay, and a lot of legal fine print, which is why sometimes you hear certain stories and you think, I mean, you know, and when we put this out on Twitter, we're saying, is it a blessing or a curse? And in some ways, you know, it's the thing that can catapult your business to the next level. But if you haven't taken care of all of those things in the basics, then, you know, the relationship is fraught from the beginning. So when you're taking a look at what that environment looks like Linda has said, hubs offer, you know, some sort of learning in this space, correct, James?
Yes.
Tell us about that.
Well, hubs, like the name suggests, should really be an access point for all it takes to, you know, build a thriving innovation ecosystem. And in that sense, would be bringing together investors, bringing together entrepreneurs, bringing together legal experts, and all these kind of, it's the place where the cooking should really take place. Yeah, so that's the typical environment in a hub. First of all, and they also work really well for first-time entrepreneurs. First-time entrepreneurs in the sense that they do not have a network. They don't know who to talk to. They don't know what it takes. They don't even know that they need a lawyer. Because established or serial entrepreneurs would have built their own networks. They would have met one or two funders, and they know their way around. So hubs really create that funnel at the very beginning to make it easy, kind of lower the barrier for first-time entrepreneurs especially to getting into business and then not getting their hands burned because they lack the know-how. So it's kind of just bringing everything together that an entrepreneur wants and needs to succeed, and facilitate in some extent those connections. So, for instance, at Lake Hub and most of these hubs, they have relationship with lawyers hub that, you know, are experts in the legal space, and also the venture capital funds. So when an entrepreneur goes into a hub, they will evaluate what's the stage of your business. Do you even need venture capital at this stage? Are you ready for it? Does your business need VC, or are you ready for debt from the onset, so you cannot lose your equity at this early stage? So those are the kind of things that hubs play a role in to prepare entrepreneurs.
And I think that's so important in terms of just getting them ready, and like you say, having one area where they can get all of this information, because, you know, we're hearing that there's hundreds of millions of dollars out there. I mean, I think in the year 2020, Kenya and Nigeria alone, I think one was $300 million, another was $305 million. That's over $600 million, not Kenya shillings, that is available and is being raised here. And yet, you know, there's many startups, there's many businesses that would require that. So it's great to know that there's a place you can go and get that information, and sort of hand-holding, I imagine, you know, throughout that process. And like you say, whether you need venture funding or not at whatever stage. We often see, Esther, a great focus on tech and I think agribusiness. Is that to say, you know, why is that? Is that a misunderstanding on our part? Why is that? And what are some of the other areas, you know, if at all, that venture capitalists are, you know, interested in?
I think you shouldn't separate tech from sectors. I think what investors look at is every sector, and then they use tech as a way to be able to scale these businesses rapidly. They're thinking about how can we quickly grow this business into new markets, into new regions, you know, and tech happens to be the tool that enables this. So, you know, we find that the businesses they invest in is ag tech, health tech, ed tech. So it's not tech and then every other business, sort of like every other sector is ignored. I'm happy to see that investments in the agribusiness sector have actually gone up, because for a long time, investors would actually shy away from this sector. Because if you think about it, in Africa, across Africa, and like many parts of the world, they're still rain dependent. And as you know, our climate is all over the place. You know, we happen to be the continent who are the least contributors to, destroying the carbon, the atmosphere.
Right.
But then we happen to be the ones who are getting the majority of, rather the brunt of the effects.
Yes.
Right.
Yes.
So, for a long time, investors would really shy away to the risky sector, but now we're seeing, a lot of investments across the value chain, not just in farmers, but, different, products that are being created out of the business, the various elements that are coming in between, solutions for farmers, solutions for market, so, I think things are diversifying. But yes, there's a heavy leaning toward tech because of the whole scaling factor.
Okay.
Although there are investors who are out there who are looking at the more brick and mortar businesses, because I feel like that's where also the bulk of the businesses are across the continent.
Yeah.
Maybe they're not typical venture capital firms, because venture capital firms are thinking within 7 years they need to make their exits, will they have grown fast enough, right? But then if you look at the other side of like private equity, they're still investing in, the more brick and mortar businesses across the continent.
What's the typical, and I know you said, it really does depend on the business, the analytics, you look at all of that and see what makes sense. What's the typical time frame of a relationship between a VC and a business, average?
I like how Linda is looking at me.
I had an answer in my head, but I'm like, you're the pro.
You first, and then we'll come to Linda.
Yeah.
Okay. I think when VC funds are set up for Africa, the goal is to exit businesses within 7 to 10 years.
Okay.
That's the goal.
Okay.
However, if you look at this continent, particularly East Africa, we haven't seen that many exits happen in this market. So it's hard to say what is the typical. I would say the typical goal would be 7 to 10 years.
Okay.
Yeah.
Okay. And in those 7 to 10 years, Linda, what should have happened? Both for the venture capital funding and for the funder and the business. So it's honest to just go forward and then we will come back. So in that span of time, what should a business have made sure they've done or gotten out of that relationship?
So this is a very personal view, but I think venture capital is pressure. Like, I'm an entrepreneur, and so I just see the introduction of pressure. Yeah. And I saw this Nigerian founder post on Twitter that since he raised money, people are trying to sell stuff to him, things he doesn't need, imagining that this is his money and it's not the business money, and so the business needs to grow within that time, and VC money is stressful money. It's people need results, they need you to grow, and sometimes when you're going to take in VC money, you're looking at how to maybe have market dominance, and you're saying, I need this money this fast for me to be the best in East Africa, so that I'm the sole supplier of this and this and this. And so you're coming from a story on paper to actually doing this. I'll say an example for Twiga Foods. They raised so much money. In the process, you could see, once they raised, you're seeing a lot of blockchain developers being hired.
They've actually just raised some more money. It's been announced, I think yesterday or today. Yes, that's right. Yeah.
And so the pressure to perform really comes in, but then also you see a lot of, now the company shifting, you have new advisors, new mentors coming in, because the VC fund is coming with their network as well. But then also you can have a lot of ceding of control. And so if you are this person, there's dilution of shares, and so if you're this person who owned 100% of the company, now you see a ceding where you're owning less, you're making not a lot of the decisions on your own, you must sort of consult. And so I think that really shifts for a business. But then you have money. So money can buy the market, it can buy new tools, new people, new talent within that space. But then also, I think sometimes just to, sort of look at, the question you asked on the danger of VC funding, because some people see it as a problem, like myself. I'm like, I want to bootstrap all my life, but then you can only take a county at a time, But with VC funding, you can simply just scale and say, we are scaling Lawyers Hub into 30 countries in Africa, But I think what people must look at is to balance and see, can we conquer this on our own, or do we need somebody else to help us? And then also look at it from an African perspective, that are you ideally ready, and do you have access to venture capital? Because it's a nice to have, but is it actually accessible for every entrepreneur, Okay,
I'll come to you, James, in a moment. What are some of the myths from your standpoint, Esther, when people come to you? What do we come with some unrealistic expectations? Wow, got the money, this is it. And do you see that in the sort of presentations that are made to you? What would you say are some of the myths, misunderstandings that we have of venture capital?
I think the first one, before even going to myths, as Linda said, you know, there are all these advisors and all, and that I've never heard anybody put that in a negative connotation. That's actually one of the benefits of having investors in your business. Well, then
let's talk about that first before we get into the myths. What, in your view, are the benefits of venture capital? So when the deal is signed, relationship is on, we're moving forward. So what do you bring to the table?
So that's one of the things, that we don't just go to any Tom, Dick and Harry, right? You do your due diligence as an entrepreneur, find an investor that makes sense to you, who has a track record on this continent, who understands the industry that you're in, right? So you're not just getting capital, otherwise just go into a bank or whatever it is, right? Okay, which is also not easy, but anyway, the whole benefit of venture capital then is everything else that comes with the capital. Capital is only one part of it. So there are, let's say, the 3 C's, capital, connections, and counsel, right? So you find a way to leverage those networks, you know, to be able to grow your business into the different markets or whatever it is you're trying to achieve, and get the counsel, and you make sure that investor has the right connections and the right advisors, and you use that to build your business. Don't look at it as a negative. It's actually positive.
I said it in a positive way. I think my concern was that, you know, the bureaucracy that comes with you not being in control, which we all must admit as entrepreneurs, because being in control means you can wake up and say, we're going to this market. But then now you have people's money, and sometimes you also don't want to go into that market, but then you have capital that belongs to a VC.
I think entrepreneurs need to be a lot more confident than that, because sorry, Lina, to say something. But you need to be, you're self-thinking, I have people's money and all of that. It's just things like, now this is the company's money, and this is, if you have a lot more confidence, and it's establish that relationship even as you're negotiating. If you start feeling like I don't have a say even during the negotiations, then that is not the relationship for you.
But I think that's what happens. Like, ideally, that's what happens. When you look at, for instance, I'll give an example. MailChimp just raised money, and they had promised their team that they are never going to take venture capital fund. And then they took venture capital fund, people are agitated, they want to leave the company. And so ideally, maybe the next steps would be them not having the ideal team that took MailChimp to that level.
But whose fault is that? That's not the venture capital's fault. The team.
It's the team. So it's the founders and the team, you know. So what ideally I'm saying is that the control that you have in the beginning as a founder, and we know
that you
we
will
know
not
the founders
have the same
syndrome in Africa especially, that you won't have this same sort of control and just simply saying we're shooting for that star, that you need to ideally consult everyone else.
But Linda, what's the value of having a control? You know, venture capital mostly come to early stage businesses compared to PE funding, right? So at that time, the value of your company might not be that much, you know. So it's a matter of trade-off. I'm giving this so that I can get this. When you're the founder in control, it means you're the only one working towards the success of this business.
That's true.
But then when VC money comes in, this VC came in the first place to exit. So meaning they want to get results. So you're just getting some extra layer of support to ensure that you reach your goals and ensure that the business succeeds. And it also helps you quickly separate you as a founder and the business, which without any external monitoring, you will struggle with for quite some time. So, you know, that level of decisions are now board decisions, not just your decisions.
That's true.
But also it depends. That's why people have to, you know, do an analysis. And like you said, most entrepreneurs don't do their due diligence on the VCs because I need the money. Whoever's ready to give me the money, especially if they're doing their first round or like the very first external capital, they won't do that. Most of the time there's pressure to pay salaries, to make business work, the money that comes. But
that's true.
Serial entrepreneurs on their maybe third or fourth business, they become more selective because it's money is no longer the problem. It's the right money that comes with the 3 C's. Is it smart capital, not just capital just coming for the sake of the money, but also behind VCs are people. You know, are they people you're going to like? Otherwise, you won't be able to work with them.
Which is why, the entire time I've called this a relationship between the funders and the business.
Especially in the way that it's like it's sort of a marriage with an exit plan. You know, so at least you know where you're going and when you're going to leave this marriage. So you just need to make sure you make it work.
I like that a lot. A marriage with an exit plan, make it work for that time. I think we're about to take a break. So just to recap what we've just said in this first part, that it is very important for you to know, first of all, speak to the people you are with in your partnership, understand what that is, and also understand that it means giving up something in return for funding. And so to just understand that, you know, you're not going to be able to have a say over all of the decisions, but what are you getting in return? You're getting funding that enables you to scale, and then do your due diligence. In the same way, the venture funder the VC funding is going to do some due diligence on you. Do the same to them.
And I was just going to comment on the Kenyan VCs. It's important to also know if they're, you know, they're in line with the regulator, for instance. Are they registered? Because I think people don't know the difference even sometimes on who is an angel investor, who's a VC. And so they will promise you money, yes, but then you have not done your due diligence, like James is saying, and confirming through the Capital Markets Authority that are they ideally registered, you know, because you can be registered as a business, but then you're not registered as with the Capital Markets Authority.
I see. Okay, yeah, so lots of lessons that we're learning here today. Very fascinating conversation. And this is why we're doing this show, so that all those horror stories you think you've heard, probably this is why. All of those great success stories, this is why. We're taking a break. We're back with more, your questions and comments as well. This is Business Now. Back in a moment. Welcome back. We are talking about venture capital funding for your business, something we're all looking forward to and learned a lot in the first part. Welcome to the second part of our conversation here on Business Now. Esther, let's start with you once again. We had just started to talk about what the myths are around venture capital funding. What are some of those that you've heard and seen? This is the moment. Let's debunk them all here right now.
I don't think we have enough time for all. I'll start with the easiest. So you're here talking about, $305 million was invested in last year in Kenya alone. And, you know, so people come and they're like, I have a business, invest in me, right? What they don't realize is fundraising is a full-time job, number one. So you don't just walk up to an investor and say, invest in me, or put a pitch deck together. Do the work. Write a whole list of all the investors in the market who fit, either your size of business, sector that you're in, and all of that. And then just know that that's the beginning. And then you start hitting them one after the other. And them saying no to you is not a sign of your business is bad. It just might mean that you just don't fit some sort of criteria or something that they are looking for at that point, right? You have to keep going at it. People talk to two investors and they come back and they're like, you VCs are just full of, all sorts of rhetoric thrown at you. You have to talk to Ken Joroga from Cellulant. How many investors he talked to before he got his $38 million? Was it 400 investors or something? He did a whole article in the newspaper talking about that. Even in Silicon Valley, it's the same thing. It's not unique to East Africa or to Kenya. It's the thing. You have to do your work. It's not a matter. It's not going to a bank and they say yes or no. You have to really put the work in, basically. The other thing is also just knowing that, I think it was James who said something about VC being a marriage with an exit. So very many founders seem to think that now that you're invested in my business, we're together for life. It's a marriage for life. So they get upset when people start coming up with exit plans and strategies and trying to see where you fit in the market and who can we sell you off to. And they can take it very personal. No, the entire way venture capital is structured is so that they can exit you. The sooner the better,
Even sooner than what was
the time frame that I talked. The sooner the better. So this whole, and then, first of all, it takes really, it's a battle to let go of equity. And then you get that equity investor in, you don't want to let them go, So those are some of the things that we see out here that, they're hilarious, but it's actually something we see on a daily basis. And I just want to encourage founders out there, just put in the work. And when you do, the results of that will benefit both you and the business that you're trying to build.
Absolutely. James?
Well, venture capitalists are in business as well. So we need to establish that they have a customer who is waiting for returns. So it's not free money. And you, the entrepreneur, the customer, you're just a means, for their business. You're just part of their business plan. So like Esther says, it's good to be prepared so that you know that you're going to put in the work even after receiving the money, because these people, they have targets, they have KPIs, and they're going to pass that down to you to meet their KPIs. And it's always important to establish at what point in your business to get VC money, and I think Linda alluded to it. If you get it in too early, you're losing too much control, and especially in Kenya, I think it will also be good to hear what Esther says, how they go about valuations, because the market is still pretty nascent. A lot of entrepreneurs lose a lot through valuations that are loop-sided on their side, so they're losing. Like their businesses are undervalued because maybe the prospects are not so clear, the African market is not so open yet. If you're in agri-tech, maybe you're in a sector that is still new, there's no reference, and that's why wins like what we're seeing at Trigger Foods really help the market, not just for Trigger Foods, but other agri-tech, because they can indicate, okay, Trigger Foods started here, with this VC money, they converted the value to this much. So that becomes a reference point to other investors as well. But where there's no reference point, because it's a business, they want to cover their risks, the entrepreneur is likely to be on the losing end if it's too early.
Okay, yeah, and let's talk about that with you for a moment, Esther, because you're, seed investors, right? So at that point, explain to us the stage of that business when it's at the seed stage, and then how you do the valuation, how you analyze the risk of your investment, and make a decision based on what factors.
Yeah, so I think the first point really is to recognize that even in venture capital, there's pre-seed, seed, and Series A all the way to whatever letter some VCs decide to determine. And this just means stage of business and stage of growth of business as well. We are different. ANCAP just happens to be different, so I need to put that caveat in really early. So we come in to businesses that have been in operations at least over a year, have a little bit of traction in the market. So you can say that you have a few customers who've actually validated the fact that our product makes sense, our solution has a market out there, right? And then we ask you a few questions regarding your financials. Most of these businesses don't really have much with regards to the financial statements. Some of them, just manual bookkeeping, not clear in terms of where income statements and balance sheets lie and what they mean for their business. So they're still really, really early stage. But we thought as ANCAP that's where the biggest gap was in terms of capital lenders or VC investors in this market. So we decided to go really early so that we can have more businesses being able to make it through what we call the valley of death. You're 2 years into the business, you need some capital to move to the next stage, So we come in really early so we can have more businesses go through that so that the bulk of the VCs can now have more pipeline to invest in. So we're very early stage.
Yeah. I don't want to go into details. Do you know how many early stage, maybe ANCAP won't want to tell us how many you've invested in. Maybe you could give us a ballpark figure in Kenya, in East Africa.
That we've invested in?
Yes.
So we have a portfolio of 27 businesses so far. We're also a very young VC investment firm. We did our first set of investments last year. 24 of them, and then did another 3 this year, and then we're doing another 100. We're actually in the due diligence phase right now, by the end of the year. But again, I said we are different. We're trying to automate the investment process because we're trying to get rid of the barriers that have been there in venture capital and investment space for a long time. So one of the things, if you talk to venture capital investors, is why are you doing things the way you do? Why, not seeing enough businesses going through, the process. You're not seeing, enough pitches out there, So we've taken away things like pitch decks. You do an application online. And then we've built in algorithms to assess businesses. So we're automating
the process.
The process. And then, just various things. Even our DD processes are affordable. One of the things we see investors talk about is doing due diligence on businesses in Africa is really, really expensive. Right. So
data is harder to come by.
And that's one of the reasons they don't do early stage tickets, because they'll say the cost of doing a deal of $200,000 is the same cost for $2 million deal. So I'd much rather do the $2 million deal, and to make a better upside for me as a VC, right? So we as ANCAP approach it differently. We're trying to see where is the need the most. And that is the early stage businesses who are out here. They're too risky for traditional lenders like banks. We don't have that fabric, social fabric like in the Western world where, there's around for friends and family.
And fools.
I don't like saying fools because if you're in Africa investing in a business, you're not a fool. If you're not an institutional, if you're somebody who's giving money to others. So we're trying to solve that. We don't have enough people playing in that really sub $200,000 deal size space. And that's where we play.
Okay. Yeah. Linda, so what does a pitch look like? What does a good pitch look like? Now that Esther said they've done away with pitch.
I think James has raised a lot of money.
Yes.
No, actually, it's good that you guys are doing away with pitches because I have a problem with pitch decks because they're modeled in a way that it's Silicon Valley driven. It's American way of telling stories. Yeah. And a lot of Africans struggle with pitch decks. It's not how we tell our stories. Yeah. First of all, pitch deck requires you to, come out and oversell the business and also just get people to buy into it sometimes, even when it's farther from the truth. And it's all this marketing language really. If you're not a good marketer, you're going to struggle with pitch deck. Yeah. So one step, doing away with pitch decks, I think it's a good way to getting a lot more African entrepreneurs at least before the desk of VCs. Okay. Because I did judge a good number of pitch decks, and the way the pitch decks are structured, it's just not the right way. So
how does a business then pitch themselves to an investor?
A lot of investors, unfortunately, up to now are still foreign investors, even playing in African markets, so they'll still judge you by the standard way. You can learn the art of having a great pitch deck, which talks about it's standardized, the problem, the value proposition, unique selling point, traction, team, and the ask. That is like usually what they want to hear. Yeah. And depends on the stage of the business. When the business is too early, let's say you have no traction, it becomes more of how convincing you are. When the business has some traction, then it's a lot easier. You can say we've captured 1% or 0.5% of the market, and it's possible what they call the total addressable market for us to capture 20-30% of it. If you gave us this money, that's a lot easier. But if you've not captured any bit of the market and your customers are hypothetical, then it's just if you're good at convincing people, then that will help you raise money.
Yeah, and that's really what like Esther said. Seeking funding should be a lifelong process. Like it's a continuous process. So you don't just do it once and you stop. You never stop trying. And then it's the idea of doing a great pitch. Yeah. So what happens when you have somebody who's not gifted in doing one of those pitches that we see that are so compelling? Yeah. I mean, I'd be honest, I'm not an investor. I don't nearly have $200,000 but there are some pitches that I'll be like, oh yeah, okay, that sounds pretty good. Just on the face of it before you start taking a look at the books. But perhaps not everybody is built to make a good pitch. So what do you do if you are that kind of person?
If you're an entrepreneur, you have to learn everything it takes to make your business succeed. Because it's not learning how to pitch or sell your business is just one of the things you'll need to learn. Yeah. You'll need to learn how to manage people. Maybe you don't do well with people, but for your business to succeed, you have to learn it. There's no other way out of it. You need to learn how to manage your finances. You need to trust your gut, because you're going to make decisions at the early stages using your gut. So I think there's no option. As an entrepreneur, you have to learn it. Another option is to get a co-founder who's good at that, who can sell the story, who can sell your business. That way you can complement each other and at least hack some of those things. But it's usually going to take a lot of learning at the early stage.
But not all investors actually go to these pitch competitions. Yeah. So if you are one of those founders who doesn't want to be on a stage making a pitch, to hundreds of people or even whatever number of people, and you're not comfortable with it, go to do cold calls or cold emails and try and lock meetings where you can able to sit down with the investor and be able to present that. It's not easy. I'm not going to try and make it look easy, but you just put that extra effort and find investors who are able to sit down with you and you can able to explain your business without having to do this theatrics and personality competitions.
I had that experience with DOB Equity. I think they do that. And they would invite you for coffee.
Yeah.
Okay.
And just have a chat about your business.
Yeah.
So
Great.
it's so unstructured,
Yeah.
yet they're learning the key points.
Absolutely.
It's not you standing doing a PowerPoint, selling everything. So
Not
it's
everybody can be Steve
yes.
Jobs, my friend.
Yeah.
And you're all seated, so it's kind of just make you not so nervous and just
Yeah.
talk about what you love. Yeah.
Okay, and I think that's where I want us to end our conversation is, so what does that good pitch look like? Whether you are sitting across from somebody one-on-one, you know, James has already taken us through, you know, the key components of that. What are the key things you need to say? And also, Linda, because I know we've done this on the show before, what are the key things not to say, you know, in a pitch? And every time I think of a pitch, I don't know why I think of Terranos, and I don't know how everybody bought that one for for so long. But you know, it's one of those things. I mean, I think the example for me of Terranos is that it does catch up with you, you know,
Yeah.
eventually at some point.
Fake
and
it
at
till you
great,
make it.
yes, and at great cost. And then, you know, we're in that space where, you know, you want to fake it till
Yeah.
you make it. You want to show people that my business is good, or if it's not, it has the potential to be. And sometimes you then fall on, you know, the other side. So this is a pitch. You are sitting, maybe you've done a presentation, or you are having a one-on-one, or you're doing a cold call, you're doing an email. What are those things you're saying about your business? Please do for us what a good pitch would sound like.
So, you know, today is not my best day.
No, but you can be your best even on your not best day. Let's go for it.
I'm going through some tough time.
Yeah, okay.
But I'd say this. I think as a startup, if I was pitching the Lawyers Hub, for instance, I'd say that we are the first innovation hub in Africa. And I'll talk about the value of the market and say what our product is, that we're sorting two problems on digital policy and justice innovation. And then talk about our team and, you know, explain exactly what our team has been doing this far, how their qualification, and then say that with this amount of funding, this is what we're able to maybe get market dominance in Africa. If we don't do this, then this is our competitor. You must be alive to who is your competitor and be able to exactly explain what these weaknesses are. That I am an engineer, but I don't have a marketing background, but my co-founder has this marketing background, and this is how we're going to get this, you know. So that for me ideally would be the sort of pitch that I would put in, knowing the percentage of the market that you already occupy, like James has said, but then also knowing, you know, who is banked and unbanked. For instance, if it's a fintech startup, that this is our solution, this is how much banks are getting, and this is how much, you know, we are capturing, and how we can even work together. Then also to talk about the successes that you have had. Have you built a community around this product? You know, have you also maybe had a few partnerships with banks already that will give you scale? For instance, if you're already working with Safaricom, that gives you access to all their agent network across the country. Somebody would want to hear that to be able to invest in the business. But then also I'd want to say two things from what you indicated. The first one is not to overpromise, that leads to fraud. But then also two, on the cold calls, if you're actually raising from the US, for instance, they're very strict on the venture capital process. So for instance, if you introduce me to an investor, then I should not pay you a success fee. It should not be based on us raising from that investor.
I see.
And so what I need to pay you is just your consulting fee, and then let it move.
Okay.
And so we've had, you know, a few cases, for instance, the US where you'd see, you know, this come up later on with the regulators.
Because once the funder is on board, and then now you're saying, oh, but there's a percentage of this that needs to go, and they're like, no,
that's
we don't
true.
do that.
And we are seeing that a lot. There's an email I got yesterday, somebody saying, I helped this startup raise, and then they have refused to give me the success fee. You know, and so you need to be very clear on what introductions are you having, what cold emails look like in that sense, and then also to see that nobody is wasting your time, because some you know, VCs are, you know, they're just not right. They would come in and give you a term sheet and just buy time and then come and say we're invalidating that term sheet. Unless there's fraud, there's no need to give a term sheet and then draw it back. And maybe Esther can speak to that. And even during the due diligence process, that you don't let people take advantage of that process. Sometimes VCs would maybe just come and lock you down so that you're not negotiating with everyone else, you know, but then they're simply just buying your time and wasting your time, you know. And then I think finally we see the general complaint across even the continent that why don't VCs sign NDAs, these non-disclosure agreements? And so somebody can come and forum shop and then simply just go into somebody else and invest in them, and because now they have capital, they can do exactly what you're doing. So I think those are the sort of small sort of issues that we must look at.
So how does the business then protect its own idea when pitching?
I think that discussion on it's a never-ending story, like especially on NDAs that are non-disclosure agreements. Ideally, you know, enforced. Do they really help? And somebody will say, it's just an idea. It's the execution that matters, you know. So I would say as a lawyer, have it, but then ideally, if a VC firm says we'll not sign the NDA, what are you going to do?
One of the things I think I'm taking from what you're saying is also one of the things I've been encouraging businesses to do. Go into these negotiations with somebody with a legal mind or a lawyer or a legal. And this is something for a long time that was not happening. So term sheets were being drafted in this Kenya and that were completely obnoxious. You know, like those sort of vulture sort of like terms in these sheets. People didn't really understand what they were getting into. So what I'm hearing from this is if I have Linda on my side, I can be able to talk about having an NDA on sections that I feel are proprietary to our business. You know, it doesn't have to be an NDA on everything.
That's true. It can be really and then the fact that VC firms now, especially foreign firms, are very clear on we are buying this business, but Kenya is going to be a subsidiary. We are moving it to Delaware. So then you are this person who just had a good idea, like you didn't think this would blow up.
Suddenly,
you know, so you need this finance guy that you know James was talking about. You need this lawyer to help you through, and then you also need to look at this term sheet. What is it talking about? Dispute resolution. If this is supposed to be sorted out in Bangkok, are you able to go to Bangkok? You know? So those small issues that, you know, are on the term sheet, just look out for them and think about it before jumping on the money and saying, you just want to do the press release that, oh, Lawyers Hub has raised $300 million, you know, like you want to show this much. Think about that term sheet, what the terms are on that.
Ladies and gentlemen, thank you so much. We haven't nearly exhausted this conversation, and that's because we cannot do it in an hour, but sadly that's our time for now. Imagine, it has.
I went by fast.
There you go. Thank you so much, and it's been such a vibrant discussion, learnings, you know, lessons learned, and you know what to do, and certainly not the last time we're having this conversation, so I hope we can call on you again. Thank you so much for your time. That's our discussion, but we also have to make time for our weekly Made in Kenya segment right here on Business Now, and this time it's about a father and son in Ruai who are taking the metal art game a notch higher by creating impressive sculptures from scrap metal. And even though they say the returns are still low at this point, they're not giving up on their dream of making Kenyan homes and institutions beautiful. Edward Chwer with that report.
Along a street in Ruai lie impressive pieces of art depicting some of Kenya's most iconic wildlife. This is the dream of a father and son who have partnered to bring the best out of skilled artisans in the area.
My name is James Bogwa from Boas Metal Art. The labor force we have is around 10, and we deal with metal art. Anything we fabricate here is made of metal.
Mbogwa and his son were initially making gates for homesteads and institutions, but took a different direction when competition went high.
So we started fabricating sculptures with the intention of beautifying our gates. But when we made the first few sculptures, we noted they are good and on their own could make very good independent products. So we started with a lion, an elephant, and a leopard. And when we were able to make them without of training more people, so we looked for artists, some who are qualified, but who are not technically trained, and we started training them.
John Kamau is the lead artist and engineer who helps draw the various designs before they are handed to the artisans to execute.
Tunaanzanga kwa kuchora hii kwa karatasi ya nylon ama polythene paper. Tunaifanya kitu inaitwa etching. Ndio tunaenda kwa sandbed. Tunaweka sandbed sababu tunataka ukigoga hiyo kitu isitoboe lakini iingie. Then we go to the stage of beauty. Beauty ni sasa ni kulete ile rangi kamili vile ilikuwa kwa picha. Toka hapo ni kuitengenezea kafulimu kazuri na kafulimu bado ya mabati nzuri na tunaweka hanga.
So far, Mbogwa has continued to diversify into more products, all necessitated by the changing market demands and customer tastes.
We checked what is the market and we checked the methods of improving to come up with the natural habitat status. If we get a lion, we check the physical size of a male. If it's an elephant, an African elephant, so we make a full size. We started the marketing. We started targeting showgrounds, recreation centers, and any event where people congregate so that they can see.
However, despite Mbogwa's products being made from cheaply available raw materials such as scrap metals, he says that penetrating the market has been an uphill task because of the high cost of labor in making the sculptures.
Unfortunately, the beauty of our sculpture does not translate directly to money because the labor concept is very high. By the time we come to finish a full-size elephant like this one, the price is very high. And in the market, many people have not understood the concept of metal art. For the category of the elephant and the giraffes, they are ranging between 300 and 400,000. The category of wildebeest, the rhinos, 280. Other small items, all of them in the range of 150 to 200.
So, what has made him still hold on for this long, even when the business is not doing as expected?
One of our concepts is conserving the environment. So we don't want to use wood, fiberglass, rubber, or plastic, or polythene, because we also target conserving our environment, cleaning our environment, and also making something that can be indoor and outdoor. We are reputed for wild animals. We have wildebeest migration, which is an annual event. We can use our sculptures to market for that.
Mbogwa hopes that Kenyans will embrace metal art, even as he looks forward to getting into homes with smaller and attractive sculptures.
We designed a coat of arms, a very beautiful one, which we checked the design, the shape, the requirement, even from the Constitution, and we made that one. And we have managed to design a trophy that can be given to a football team, an athlete who wins. We are importing almost everything from China, and we have no problem with that. But if it can be made in Kenya, why import?
Edward Chweya, Business Now, Citizen TV.
We're going to be talking about this. I mean, I think I read a tweet here from somebody who said, I hope I can find it. You said that your daughter, after watching our show last week, actually went to a bank. I will not name it. And you said she had a great viable idea and they only gave her advice and, you know, sent her on her way. As Esther said today, funding is a long-term job. So hope she doesn't give up and continue to build on that idea. She can also go to a hub and sort of get the advice that she needs. And of course, make sure that she also ties that up with the legal as well. We'll talk about this again some more. James Odede, Esther Ndeti, Linda Bonya, thank you for being on our show today. And indeed, yourself for watching and your comments and questions, which I don't have time for today, but thanks for watching. And just to remind you that Made in Kenya is here every week. On Monday, we focus on Kenyan-made businesses. And so if that is something that you want to do, hit us up. The hashtag is Business Now, hashtag Made in Kenya, at Yvonne Okwara, at Citizen TV Kenya. That's our show today. We will see you again next week. Bye-bye.
Entrepreneurs across the country are belting up, innovating and diversifying to sustain their businesses.
We have our own fundis who come and weave the papyrus reeds together.
They are inspiring other entrepreneurs and growing the economy.
Our products mainly includes delivery boxes for motorbikes.
Our products can be used with nails.
The manufacture of custom-made roofing solutions.
Every Monday we celebrate them and tell their story, their experiences, challenges and their triumphs. Made in Kenya, every Monday on Business Now.